Over 66,000 buy-to-let companies were set up in the UK last year. That's up 8% on the year before and 340% on 10 years ago. In this video, I'm going to break down why more and more people are setting up UK limited companies to own property. I'm going to give you an example of owning in your personal name versus owning in a company and what the profits and tax looks like in each scenario. Thirdly, we'll then look at how you actually set one of these things up. And lastly, a couple of the FAQs around this, such as can I transfer existing properties owned in my own name into a company structure? Who am I to be able to talk about this? My name is Callum Williamson, 10 years living as an expat, 15 years in property. I have owned and do own property in both my own personal name and within a company structure. So I have experience talking from both sides of the fence or the coin, and will endeavour to give you my insight and experience on both. According to the data then released recently, 66,500 buy-to-let companies were set up in the UK in 2025, taking the total number to about 450,000. You can see from the chart here, the numbers have been slowly increasing and becoming potentially a little bit more exponential in recent years. So why is that? In my opinion, the first and foremost reason, and perhaps the most crucial, is due to MIRAS. That's mortgage interest relief at source, and basically means that you can deduct the cost of your mortgage interest off your tax bill if you own in a company structure. You used to be able to do this in your personal name, but that changed about 10 years ago. Now you can't, you just have a credit, a flat credit, and you can see from the chart, the sort of increase in companies tallies with this change coming in. So the biggest point to consider is the fact that you can deduct your mortgage cost off your tax bill. Secondly to that, there's been more tax changes, namely in the autumn budget at the end of 2025, which again, make it more favorable. But let's just have a look at a worked example just to help you visualize what that looks like. Okay, so we're looking at the two examples here. Is in your personal name, and what we've got is rent of £1,000 per month. That'll give rent in total of £12,000 per annum. In this example, your mortgage cost is £500 per month. So as we know, the difference between those two would mean an actual profit of £500, right? But because it's owned in your personal name, you can no longer do MIRAS, mortgage interest relief at source. You've now got, in the eyes of HMRC, your Registered Revenue and Custom, your actual profit is 1,000. It's not 1,000 minus 500, 500 is 1,000. So you pay tax on 1,000, which is taxable income of £12,000 per annum. Now, if you're a higher rate taxpayer, which we are assuming you will be, because if you're building a portfolio, you will get there eventually, if not already, then you are going to be paying 40% on that, which is £4,800, which, after you deduct that from your actual profit of £5,000 a month or £6,000 in total, you're left with £1,200 at the end of the year. Now, yes, there are other costs involved here, but we're keeping it simple for the sake of this illustration. Now over here, the limited company structure, exactly the same. Your rent is £1,000. Your mortgage is still £500, but in this instance, because it's in a limited company, as you should be able to, you can deduct your costs off your tax bill, which means your actual profit is £500, but it is also taxed at £500 in the eyes of HMRC. So your taxable income in the company structure is half that. It's £6,000, not 12. Additionally, because it's in a company structure, its corporation tax rate, which at the entry level is 20%. So your £6,000 taxed at 20% is £1,200 in taxable income. If you take this off your actual profit, what you're left with is £4,800 at the end of the year, as opposed to 1,200. So it's 4 times higher owning in a company structure versus your own personal name. And as I say, there are other costs involved here, management fees, these sorts of things, but this is just a simplified example from a tax perspective. That therefore, in my opinion, is the principal and main benefit to setting up a company. And more people have realized this, and so more and more companies are being set up. Additionally, as of the autumn budget last year, 2025, there was an extra 2% tax levied on rental income from investments, including investment property, if owned in your personal name. So that's even more of a reason to own via a company structure. Now, does this mean it's impossible to make money in buy-to-let and buy-to-let is dead, as I'm seeing online a lot at the moment? I think it means the opportunity and the landscape has changed. If you own in your personal name and you're an accidental landlord, maybe you bought a house when you lived in the UK, you moved overseas and you rent it out, it's owned in your own personal name, then that is no longer as appealing and is not going to make you as much money or any money long term. Really now, to be successful in the new world of buy-to-let, you need to treat it as not a job, but you need to treat it as a professional with a company structure, looking at the fundamentals, getting a good yield, these sorts of things. And if you do that, then there's still money to be made. Because after all, why would massive multinational companies be buying up UK property by the billions? Why would they be doing that if it wasn't still a good long-term opportunity? A few of the other benefits then, two in my opinion, would be the way you can take income from the company. Any money lent to the company to buy properties can be taken back tax-free as a director's loan. So let's just say you've paid 250,000 into the company, split across 4 properties, 4 lots of deposits. You can take that back as a repayment of director's loan, tax-free. Additionally, you can charge yourself interest on that loan, so 6% interest on that, for example, because it's got to be in line with what the market is currently doing. You can't charge yourself 20%, for example. That would be income of £15,000 per annum that you can take, and you would pay tax depending on your jurisdiction on that. This is not tax advice, just my experience and opinion. Okay, then how do we set up a limited company? There's 2 approaches. You can do it yourself online via Companies House, or you can work with an accountant to do so. So for a quick example of this, I was working with a lady in China recently, and we looked at doing it online via Companies House, and after about 45 minutes of being asked for documents, of having to use her home address as the registered address that everyone can see, we packed it in and decided to just work with an accountant. I'll put a link below down to where you can do it yourself if you wish, but the way I've done it and the way I would recommend doing it, because it saves you time, is working with an accountant. They'll check Companies House for you, they'll see if the names are ready, they'll tell you what documents you need, and they will use their address as your registered address. And then the added benefit of that is that they will help you and work with you to do your tax returns every year and keep you honest, as mine do for me. And yes, you pay them for that, but it's a fee worth paying. Now, who should consider setting up a UK limited property to own company? UK limited company to own property. In my opinion, there's very few instances where you shouldn't, but the ones that maybe you should consider owning it in your personal name would be if you are, for example, never planning on moving back to the UK and you only intend on buying, say, 1 property. Everyone in the UK has a personal tax-free allowance, £12,570 at the time of recording this. So if you're buying 1 property, say £200,000 with the 6% yield, that's £12,000 a month, that would be nice, a year in income, you're below the tax-free threshold. In that instance, you just do a non-resident landlord form and you do your own tax return. If that's the plan and you're going to stay overseas, then maybe that's the easiest way. But if you were to move back to the UK and start earning, then your earnings would be on top of the property earnings and you're already outside of the personal tax-free allowance. So that, I think, is really the only situation I would consider it. If you're looking at buying 1 or more, which I guess you may be if you're watching this video or this channel, then the best way to do it is using a company structure. So can you transfer in existing property into a company? I met a gent in Saudi recently. He's got 5 properties owned in his own name, has done a very good job, but now is looking to move these into a company. So the question is, can I do that? And yes, you can. Should you do that? Probably not. Why? It's a double taxation event. You're paying capital gains tax on the sale of the property and then stamp duty again when you buy it back in. And if you look at the figures and you map it out, you're looking at a 20, 25, 30 year repayment period to make that worthwhile. So probably not to transfer in existing stuff, but for existing properties, but for new properties, it is definitely worth doing. Another question I get on this is another statement I get on this is interest rates are much higher if you're owning via a limited company. Yes, they are marginally higher. They used to be an awful lot higher, but as with any market, supply and demand dictates the price. And so as more and more people are setting up UK limited companies, now, as I say, it's 450,000, over 66,000 last year, the market is getting bigger. And what does that do? It pulls in more lenders, banks and mortgage companies who want to take advantage of that. And when you have more people coming in, you have more supply, price comes down, in this case, the interest rate. So yes, it can be a little bit more expensive than your own personal name, but it's not as expensive as it used to be, and to be honest, I think an extra 0.25% on interest rates equates to about 40 quid a month on a £200,000 mortgage. So at 5%, the difference between 5.5 and 5% interest only is about 80 quid a month, which works out at £960 a year. But, and here's what you've got to remember, all of that can be a cost that you can deduct off your tax bill. So although you may be paying more interest, it doesn't necessarily matter because you are deducting that and reducing your tax bill. So that is something to consider. If you'd like any more information on this topic in particular, then there's a link below that you can hit to sign up to our 30 emails in 30 days that goes through all the steps required from starting from scratch to building a £10,000 per month property portfolio, where we will cover all of this sort of stuff, including the tax and the breakdown. Anyway, thanks for listening. I hope you enjoyed, and hit the subscribe button if you fancy it.